Today, folks, I'm back at it again, discussing the roller coaster ride that Tom Lee is now predicting, calling a tumultuous market in the coming months, followed by a ripping all-time high in the S&P as we put real data behind this man's mouth and we break this down. If you're on a path to financial independence, go down there, subscribe, join me on that fast-track journey, and slap that like as we get right into this.
Near term, you acknowledge that there could be some bumpiness, choppiness, but by the end of the year, you think 6,000 on the S&P.
That's right. I think we're still in the midst of a...
One sec. 6,000 in the S&P, just to remind you, would put us at an extra 5% for about a total of a 25 to 30% gain in 1 year in the S&P, which is crazy, the ripping runs we've seen this year.
A very tricky period because we've got the election in less than 35 days, and now we've got two things that investors don't know how to discount. One is, mounting tensions in the Middle East, and then a port strike that is potentially going to cripple the economy. And so I think that as investors worry about this, if we get a dip, and a big dip, I think you still want to buy that dip because the setup into year end has a lot of tailwinds.
So look, let's not misunderstand what's going on with these port strikes in the major coastal cities in the States, down by Florida. And you see these signs in a lot of these photos that I've noticed that says automation hurts families. And if you haven't seen some of these videos, I think this is going to become a prevalent conversation in many sectors over the coming years until the government finally steps up and says we can no longer have an economy where we can handle automating jobs away. We are seeing an influx of automation. There's a depression right now going on in software engineering because, again, ChatGPT is writing script and literally cutting the workforce of 3 to 5 people for now the job that one person can do utilizing these software tools. We're not going to just see this happen in one sector. It is going to happen across all sectors in kind of a domino effect like fashion, I think. And I think, again, the government is going to step in and it's going to be the major black swan, the major problem with capitalism in the coming years. You cannot argue the fact that not only does this help the S&P, but it's going to hinder it at the exact same time. So let's just keep listening and point out that this is just such an interesting time we live in.
The worst case scenario for the port situation is something that we've seen. And we shut down an economy already, and that was probably a time to buy.
I really love the way they're not making a big deal out of it. Like, oh, we've shut ports down before. We've been through pandemic. Buy the dip. You'll be fine.
We know that. So we've seen that movie before. Could it be? I can't imagine it could be as bad as the pandemic, but we have shut down an economy before.
Yeah, that's right. So I think it creates headline risk because, the longer this strike lasts, there'll be companies that miss. And so S&P earnings might get downgraded or some stocks might miss results. But that's all just temporary. I mean, those are just short-term headwinds because it doesn't change the long-term outlook.
It's very strange that I don't remember any war that lasts, where the effects, and we've been through quite a few.
We kind of yammer here. We get the geopolitical stuff. We kind of get what's going on. Let's just skip to the 3-minute mark.
Different because we are hovering near highs and we're in an extended market.
And things aren't cheap in terms of multiples.
That's right. But at the same time, we also know there is a lot of cash on the sidelines.
Right.
Because margin debt hasn't risen for 4 months. I mean, that's pretty unusual with a rising stock market. And now money market cash has actually been rising at a time when the Fed is cutting. So I do think...
Now, again, we haven't got material cuts, and what money market funds might be seeing are people just trying to lock in yields right now, because, again, yields are still historically high. Now, I think he made all the major points here, and I think it's really intriguing when you actually point out margin debt, because I think it's a little bit of a stretch saying, oh, well, margin debt's not at all-time high yet. There's still room for people to use margin, and I'm kind of bullish on that sentiment too, because as interest rates come down, it's going to be more feasible to take out margin and get returns on the market. Because if you can get margin below 5%, let's say, and you get a yield on a bank stock, like here in Canada, you can get 5 or 6% comfortably and safely. I mean, you can squeeze out starting 1-2% on the dividends and then hope you get some capital gains. That's what people tend to do with margin, right? And we're seeing margin debt sit at about $797 billion. I think this is in the billions, if I'm not correct. Yeah, the $1 billion level here of insanity. I'm not a guy that would ever use margin to any major extent, but we can see that it's kind of leveled off. It's not not at all-time highs, but it's not at recent lows either, and it's just kind of playing this trend line, at least until I think we get lower rates. Same thing with money market funds, right? Like, you need a material impact on an interest rate before people are really going to start shuffling their money around. That's why this is going to be kind of a slow roll into this, and we do not have Q3 data just yet. But yeah, Q2 data hit records of 6.5 trillion in money market funds, which is crazy. But I want to pivot to what he's talking about with an overextended market, because I've discussed valuations are in the upper range. They're a little overextended based on future hype, future expectations of artificial intelligence baking into the Mag 7, right? Which hasn't happened yet. We're pricing in something that just does not exist. And we've seen it with the new flagship, Apple iPhone 16, I think. Is that the newest model, right? That no one really cared about because it seems super underwhelming. You get an extra button for something that, like, I mean, when it comes to the camera, I mean, they really emphasize the extra camera button, but to access the camera, all you really had to do was slide your phone. Why do I need an extra button for that? Like, things that just seem nonsensical to the point of trading at a 34 times multiple makes no damn sense. How does Apple, in a period where they've had absolutely no revenue growth, have just been inching out slight earnings per share growth, trade at the highest multiple that it's ever seen throughout its history? Because people think there's going to be some huge upgrade cycle, which largely in a high interest rate environment, past performance in this case might equal future return, and people still don't have that extra money to buy that new MacBook or that AI iPhone 16, right? So if that doesn't come into fruition in this next earnings cycle or in the coming earnings cycle, we're going to get buyers exhaustion. That's what we're going to see happen. Now, Apple, I think, is an exception because most of the S&P Mag 7, I would say, are trading more toward fairer values, the upper end of values, but more toward fair values. Like, Microsoft's been underperforming the S&P this year at a 35 times multiple. For a company that has this kind of stable revenue growth, is having nominal revenue growth even at the scale of, $250 billion. I mean, it's making absurd money on an annual basis, and has returned back to the growth rates it saw in 2018 and 2019, being in this kind of, mid-teen range, is much better for the company. Though I still think a 35 times multiple is a little extended, considering in 2019, 2020, it was trading around 30. We're not that overextended, but again, we're still trading at upper ends that it has to justify, which it could with ChatGPT. I wish it brought ChatGPT public. It could have really justified a lot of shareholder value doing so. But, we're just going to have to sit and see what the earnings bring for Microsoft as well. Nvidia, now being the third largest company, is a wild card to me. I do not trust it. It does not make money off the end consumer like me or you. We're not buying Nvidia products driving this growth. It's primarily Meta. It is primarily Tesla and Amazon and all these companies that are building these mass computing centers that, for as long as they continue to gobble up those H100s, those H200s, all the new graphics cards driving AI, Nvidia will do well. But if we ever head into a recessionary environment where these big companies are going to cut back on spending, or again, they're making their own graphics cards like we're seeing now, their own AI chips, Meta, Amazon, all releasing their own AI chips to make up for some of the supply slump, that at some point could start hurting Nvidia, right? And we're already seeing buyers exhaustion here. The stock had blowout numbers, but it has to keep blowout numbers to even hold the valuations it's holding today. And again, we've seen the cycles come in ebb and flow from crypto, when the CEO could only go on about crypto mining and how that blew the stock up into 2022, followed by a wicked almost 70% correction into the next hype cycle. Nvidia is a wild card. I just try not to look at it as much of an investment outside of it, playing the ebb and flow of the S&P top 10. Now, Google in the lower half of the S&P Mag 7 is where I'm most intrigued by, because this is where I would say there could be potential for value if growth rates pick back up, because people keep saying Google's cheap, Google's cheap. It's really not cheap. It's more fair value, in my opinion, because the growth rates have not returned back to the 2019, 2020 level. We're trading in the mid-teens, and we haven't been able to get like a big oomph of growth by any metric, which really starts to justify a 20 times multiple. Like I said, Google's, I think, a great company. It has some headwinds with search that I still think could be a big concern, but I have nothing against Google. I think it's one of the more favorably valued companies. Next to things like Meta, Amazon, I know people think is trading at a discounted level, but the reason that it's flatlined for the last 5 years or so, 3 or 4 years, is because they haven't seen a return to growth, right? Like, they're trading at what is a mature company. To be growing at a 10% clip is incredible when you're making like over $500 billion in annual revenue. But ever since the interest rate cycle happened, boom, like their revenue growth fell off a cliff, and it's never fully recovered back to where it was in 2018, 2019, right? So I wouldn't say Amazon's cheap here, but I'd say it's favorably valued. And Meta, again, was favorably valued in the past, but because their growth rate is fully kind of returned back to where it was, several years ago. It trading at a 29 times multiple, I think, is more favorably valued, which again comes back to the point that we're in an extended market that needs earnings now to justify the values that we set at today to keep the market momentum moving higher. But we have headwinds. As he mentioned, we have an election cycle coming up. We have port strikes. There's always some other event. These geopolitical events continue to ramp up. And here we sit at a 29 times multiple, which anytime we get massive spikes in S&P value, we tend to get some healthy corrections. I want to see a healthy correction. I'm a guy that always lives and loves a bear market because that's where me and you have gotten rich, buying the dips, because we're not a bunch of wussies. We don't sour away from dips, baby. We just shovel that money in. We're a squirrel that finally found our nut. That's when the market dips. But in the meantime, I'm just going to keep cost averaging, right? And I think we're still going to see what I have been predicting, which tech is going to have a hard time justifying values here, could stall out a bit. But as interest rates continue to come into play and they continue to get cut, we're going to see the lower half of the market continue to see benefits. We've only just seen a little bump in the lower half of the S&P 500, but if we continue to see, excelled interest rate cuts, eventually quarter after quarter, we're going to see an excelled rate of cash flow returning to some of these companies that have heavy debt or infrastructure oriented. That is still the play here, folks. And I'm really shocked to see companies like ExxonMobil popping off here at a period where oil is very suppressed. I mean, with all the geopolitical events and everything going on, I guess the government has loosened regulations enough. They brought oil back to the Western world. I don't know what's happening, but for oil to be trading at the levels it's trading at and Exxon to be going up, I'd be a bit concerned. I don't think oil, can do well in a lower oil price environment. It's the ebb and flow of commodities. So just be a bit careful with these because again, they're very volatile when it comes to the geopolitical stuff and what's just going on. And there's no certainty to this. But from my understanding, as it stands today, there's still a lot of fear in the market. We're still seeing gold continue to hold highs. I think this is a good sign that there's fear in the market. We're still seeing money market funds grow quarter over quarter. I think there's still good signs that people are concerned, right? But if those concerns get alleviated, earnings come out okay, we could easily see 6,000 in the S&P. I wouldn't be surprised this year. But again, I don't know. I do not have a crystal ball, but I know you do. So let me know what you think in that comment section below.